Americans for Fair Taxation presents the Weekly Chairman's Report, written by Steve Hayes, president of Americans for Fair Taxation, and recorded by Bob Paxton, a volunteer with the Florida FAIRtax Educational Association. And now, this week's Chairman's Report.
Hello, I'm Bob Paxton with the AFFT Chairman's Report for Friday, January 5th, 2024. The value added tax. How does it compare to the fair tax? The fair tax is a tax on the purchase of new goods and retail services collected when the retailer sells to the consumer. The value-added tax, or VAT, is a tax that's calculated and paid at each step in the production process of goods and services. The Tax Foundation reported that the United States relied much less on consumption taxes than other OECD countries. Taxes on goods and services accounted for only 17.6% of total tax revenue in the United States, compared to 32.1% in the rest of the OECD. That's because all OECD countries except the United States levy value-added taxes at relatively high rates. Now, there are two types of VATs: the credit invoice VAT, which is used by most countries, and the subtraction method VAT, which is used only in Japan. Now, here's a description of each type. First, the credit invoice VAT. Under the credit invoice VAT, each time a business sells a product, it calculates the VAT by applying the VAT percentage to the sales price and then deducting any VAT previously paid in the production chain up to that point. To get the credit for VAT previously paid, all businesses must provide invoices showing the VAT paid when they sell the product. The U.S. Chamber of Commerce published an introduction to the value-added tax and included this example, assuming the VAT rate is 10% and the final sales price to the consumer is $500. The total VAT owed is calculated as follows. First, the wheat farmer grows, harvests, and sells wheat to the miller for $50. He pays a $5 VAT, which is 10% of the $50 sales price. The miller processes the wheat into flour and sells it to the baker for $150. He pays a VAT of $10. That's 10% of the $150 sales price for $15 minus the $5 previously paid by the wheat farmer. The baker then uses the flour to make bread and sells it to a retailer for $300. At this step, the VAT is $15, 10% of the $300 sales price, or $30, minus the $15 previously paid by the farmer and the miller. Then finally, the retailer sells the bread to consumers for $500, paying a VAT of $20. That's 10% of the $500 sales price, $50, minus the $30 paid by the wheat farmer, the miller, and the baker. Now, the consumer ultimately pays the total VAT of $50, which is 10% of the purchase price, but to get there, the VAT amount had to be calculated and added to the prices all along the chain of production. Then there's the subtraction method VAT. Under this method, a business pays the VAT on the difference between the business's sales and the amount of the purchases made to produce the products that were sold. Now, the end result is the same, but the calculation formula is a bit different. Now let's look at the similarities and differences between the fair tax and the VAT. First, the similarities. Both the fair tax and the VAT are border adjustable because they only tax consumption in the country in which the products are produced. Exports don't include the tax. Imports are fully taxed and don't provide an incentive to provide products outside of the country, unlike the income tax. Both plans require the businesses purchasing from other businesses to keep records showing either an exemption from the fair tax or invoices showing the amount of VAT paid earlier. Both are consumption taxes that don't penalize earnings and investment by their citizens. Neither requires individuals to file tax returns, and the fair tax or VAT amounts can be shown on each consumer purchase, or they can be included in the price of the consumer goods. Now the differences. Under the VAT, all businesses must calculate and pay the tax. Under the fair tax, only retail businesses collect the tax from purchasers and then remit it to the government. A VAT requires the IRS or a similar agency to administer and enforce it. The fair tax is collected by the states and then remitted to the federal government. No administration or enforcement is required at the federal level. Under the fair tax, evasion is much more difficult, given that over 90% of the sales of new goods are made by less than 10% of the country's retailers. Under the VAT, evasion is easier because businesses can either pay partly in cash for goods and sell goods for some cash and some checks, or they can get false invoices that they can credit against VAT owed. In conclusion, 40 years ago, the VAT was considered more easily monitored and collected than a retail sales tax. At that time, most retail sales were done primarily by large numbers of small businesses that were not using electronic cash registers running point-of-sale software. A lot of manual accounting was required, giving rise to inaccuracies and opportunities for evasion. This is no longer the case today. In the U.S., over 90% of retail sales are done by less than 10% of the retailers using sophisticated inventory and sales programs. Both the VAT and the fair tax eliminate filing of personal returns by individuals, but the VAT requires an enforcement agency like the IRS. Congress is now listening. Many are concerned about the growing upset with the present income payroll tax and the growing support for the fair tax. This was very obvious during our testimony before the Ways and Means Committee in December. Now, the choice is easy. Do we want a system for funding the federal government that is so simple that everyone can understand it, that shows the cost of the federal government on every retail receipt so we all understand what we're paying, that helps U.S. companies compete with foreign competitors, that keeps jobs in the United States rather than exporting them to other countries, that permanently makes Social Security and Medicare solvent, and finally, that is the largest transfer of power from D.C. to the people since the Constitution was adopted. Now, D.C. is ignoring the one real solution that allows us all to remain citizens and not subjects, the fair tax. The fair tax is simple, it's non-invasive, but most of all, it works. The solution: pass the fair tax. The fair tax transfers power from Congress and the bureaucrats to the people. We, not D.C., will decide how much federal tax we pay. Join us and take back control of our country and our lives, not with bullets, but with the elimination of one of the biggest threats to our liberty and economic prosperity, the income payroll tax. We should all remember Edmund Burke's warning that applies to our efforts to take back control. Nobody made a greater mistake than he who did nothing because he could only do a little. Please go to FAIRtax.org and invest in Americans for Fair Taxation. It's an investment in your and your family's future.
This has been the Weekly Chairman's Report, written by Steve Hayes, President of Americans for Fair Taxation. Check back every week for news and information about the fair tax, and learn why the fair tax should replace our antiquated federal income tax system. If you'd like to receive a copy of the Chairman's Report in your inbox every week, sign up at FAIRtax.org.